everyone, welcome back. I am so excited. I hope you are too, because we are starting a new unit. We know it's a new unit because I have a new outfit on. So this unit is about asset dispositions. The first module is going to focus on basis and holding period of assets. So basis has a huge impact on the amount of gain or loss that a taxpayer is going to realize when they dispose of an asset. And then also the holding period is very important as well, because the holding period is going to have a huge impact on the taxation of that gain or loss if it is recognized. So let's go ahead and look at what we are covering in this video. First, we're going to talk about purchased tangible property, and then we'll also talk about the basis of securities. So first off, purchased tangible property. Basis in general is the cost of the property to the owner. So this is going to include the amounts to purchase the property. So not just the purchase price, but this includes anything you would see on the invoice for that item. So the purchase price, the sales tax, any excise tax, anything like that is included in the basis. Also, costs to prepare the property for use. Now, what might this be? This could be shipping, installation, testing of that asset. If you have to do extensive testing on it before you can actually place it into service for your business, then those are going to be included in the basis as well as costs to place the property into service. So inspections, permits, anything like that that needs to be done to prepare the asset for use and service. Now, let's talk about the difference between real property and personal property. Now, notice the term personal property is different than personal use property, okay? So real property is land and all items permanently affixed to the land. So land, including any buildings on the land, any fences, parking lots, anything like that that you cannot move. It's affixed to the land. Personal property. Again, this does not mean personal use property. Personal property can be personal use or business use, okay? Personal property just means not real property. Any property not classified as real property is considered personal property. This is movable property. Machines, equipment, vehicles, anything that you can move that's not affixed to the land. Okay, let's look at an example of calculating the initial basis of an asset. So a taxpayer purchases some equipment that's going to be used in a business. The cost is $5,000. The shipping cost for the equipment is $500, and installation is $200. Determine the basis. Simply, all of these costs are going to be included in the initial basis. The tax basis is $5,700. It's the $5,000 cost plus shipping of $500 and installation of $200. Shipping and installing is part of preparing that asset for use and placing it into service. If they bought this equipment for $5,000, but then they didn't get it shipped to them, would they be able to use it? No, they wouldn't be able to use it in their business if it was still sitting at the place of business where they bought it from. So they had to ship it. They had to install it before they could use it. All of these costs are included in the initial basis of that equipment. Okay, now let's look at holding period. The holding period of purchased property begins on the date it is acquired. Simple enough. Now, basis, we were talking about initial basis, but the basis is reduced for accumulated depreciation. So that initial basis is adjusted downward for the amount of any depreciation taken on the asset. The basis that has been adjusted downward by the accumulated depreciation is known as the adjusted basis of the asset. And we will refer to the adjusted basis a lot. So Remember, the adjusted basis is the initial basis of the asset reduced by any accumulated depreciation on the asset. So just a note about the Part 1 exam and depreciation. So again, depreciation allows the taxpayer to recover the cost or other basis of property over the time it's used. This is most often tested in Part 2 of the exam, entity taxation. But for Part 1, you need to understand depreciation as a concept in general. You're probably not going to get a ton of questions about depreciation itself, but it's an important foundational concept to understand for other topics on the exam. So, individual taxpayers can take depreciation for property used in a trade or business or for the production of income. Okay, so let's calculate the adjusted basis of an asset. So a taxpayer has a milling machine that was purchased for $10,000. That is the taxpayer's initial basis. In year 1 and in year 2, the taxpayer deducted $1,000 for depreciation on that machine. So year 1 depreciation, $1,000. That is going to decrease the basis. Year 2 depreciation, $1,000. Decrease the basis. So required. Determine the adjusted basis of the machine at the end of year 2. Well, accumulated depreciation at the end of year 2 is $2,000 because we have taken depreciation of $1,000 for 2 years in a row. So that's $2,000 of accumulated depreciation. And that is going to adjust the initial basis of the asset downward. So $10,000 initial basis minus the $2,000 of accumulated depreciation is an adjusted basis of $8,000. All right, now let's switch gears and talk about the basis of securities. So securities are a little different, but conceptually, they're really not all that different from tangible property. The initial basis is going to be the purchase price paid plus any costs associated with the purchase. So just like we said for tangible property that is purchased, anything on the invoice is included in the basis, right? So it's similar with securities. Anything that was a cost associated with the purchase itself is included in the basis. This includes brokerage commissions, transfer taxes, and other fees. Now, this is important. Taxpayers should maintain records of anything that affects the basis of the securities, such as stock splits or stock dividends. Why? Because when a taxpayer eventually disposes of these securities, they need to be able to prove their basis in those securities, because that is going to have a huge impact on any gain or loss that they realize at the time of disposal. So anything that happens that affects the basis of the securities, the taxpayer needs to be maintaining those records. Basis spreading adjustments. So under the tax law, receipt of a non-taxable stock dividend or stock split requires the taxpayer to spread the basis of their original shares over the original shares and the new shares received. We will look at an example of this, don't worry. But ultimately, this results in the same total basis, but a lower basis per share. So the taxpayer still has the same total basis they had before this non-taxable event, but their basis per share is what changes. Okay, brokerage records. Brokers are required to provide basis information to the taxpayer on Form 1099-B. 1099-B is proceeds from broker and barter exchange transactions. So the broker needs to provide this to the taxpayer. Now, sometimes taxpayers will need to provide their own research to figure out what is going on with the basis of their securities. So they may need to research historical stock prices and corporate actions to determine the correct basis of their securities. They may need to look up old statements, contact the brokerage, or research historical stock data on financial websites. So let's look at the relevant forms and schedules. Form 8949, Sales and Other Dispositions of Capital Assets. This is used to report the sale or disposition of capital assets such as stock or securities. Schedule D, Capital Gains and Losses, is used to report overall capital gains and losses. So Schedule D summarizes the information from the 8949. You need both, but the 8949 is more detailed, showing each transaction, and then Schedule D summarizes the information to report the overall gain or loss. Okay, so let's see how this basis spreading works. A taxpayer purchased 100 shares of stock at $11 a share, so their total basis is $1,100. So there is a stock dividend that's going to occur, but before the stock dividend, they had 100 shares at $11 a share. Their total cost basis is $1,100. Then they receive 10 additional shares as a result of a stock dividend. So they get 10 additional shares. After the stock dividend, they have 110 shares. Now, their cost basis did not change. So they did have 100 shares, now they have 110. They did have a cost basis of $1,100. That has not changed. They still have the same total cost basis. But now the basis per share is $10 per share, because that is what is going to change when a non-taxable stock dividend or stock split occurs. The total cost basis remains the same, the number of shares changes, and so the basis per share is what is affected. Okay, that's it for this video. I'm going to see you on the next one. Let's keep going, okay?